Silver dropped 11% in a single session. Not a correction, a liquidation. The kind of move that wipes out leveraged positions, triggers stop-loss chains, and sends retail into panic mode while institutional desks sit quietly on the other side of the trade. The question isn't whether this was painful, it's whether this was engineered. The surface explanation is simple: dollar strength, rate volatility, future selling pressure. Silver always amplifies gold's moves because it carries dual exposure, monetary hedge and industrial commodity. When risk-off sentiment hits, leveraged players exit fast. ETF outflows accelerate. Margin calls force liquidations. The result is a cascade that looks like chaos but follows a predictable pattern. But the real story sits beneath the price action. Silver doesn't just fall harder than gold because of volatility. It falls harder because the market structure allows it thin liquidity, concentrated futures positioning, algorithmic triggers designed to hunt stops below psychological levels. This isn't a flaw, it's a feature. Large players understand that retail buys momentum and panics on drawdowns. They also understand that the best accumulation windows open when fear is highest and conviction is weakest. Look at what smart money does during these drops. They don't sell into the crash. They wait for the liquidation to complete, then step in while headlines scream risk and amateurs capitulate. This isn't speculation, and it's observable behavior across every major commodity washout over the past 2 decades. The buyers at the bottom are not the ones who are buying at the top. So is this the buy the dip moment? 3 signals matter. First, whether the move hit a structural support zone, not just a round number, but a level where previous accumulation occurred. Second, whether volume patterns show exhaustion rather than continuation. Third, whether the macro setup that drove the bull case is still intact or fundamentally broken. If the thesis was monetary debasement, supply deficits, and geopolitical instability, none of that reversed in the last 48 hours. What reversed was sentiment, but risk is real. If silver continues lower, the next support zones sit deeper than most expect, and a recession that kills industrial demand would remove half of silver's bid. A Fed pivot that strengthens confidence in fiat would reduce the monetary urgency. And if this wasn't a liquidation but the start of a larger unwind, then catching the falling knife early means holding through more pain before any recovery takes shape. The strategy depends on positioning. Dollar cost averaging removes the need to time the exact bottom. It spreads entry risk across weeks, not hours. Lump sum buying requires conviction that the worst is behind us, and that conviction should be backed by more than price alone. For long-term holders, crashes are noise. For short-term traders, they're traps. Unless the exit plan was defined before entry. This wasn't a breakdown of the silver thesis. It was a test of who's positioned for years and who's positioned for headlines. The market just showed you which side panics and which side accumulates. Your response to that tells you which side you're on. What matters now is whether you're reacting to price or responding to structure. Price creates emotion, structure creates opportunity. The players who profit from volatility don't chase moves, they prepare for them. They know silver's behavior isn't random, it's cyclical, manipulated, and ultimately tied to forces larger than any single session's action. If you're buying, know why. If you're waiting, know what you're waiting for. And if you're selling, understand who's on the other side of that trade. Because in markets built on fear and coordination, the ones who move when everyone else freezes are the ones who shape the next cycle. This crash wasn't the end of anything, it was a filter. And filters exist to separate those who understand the game from those still learning the rules. Silver just dropped 11% in a matter of days. And if you know how to read what's underneath price action, this isn't panic, it's structure being tested. The chart isn't breaking randomly, it's probing the exact levels that separate accumulation from capitulation. And what happens in the next week will tell you whether this was a shakeout or the beginning of something much worse. Right now, silver is sitting near $32 after falling from $34.80. That's not just a pullback, it's a retest of support that hasn't been challenged this aggressively since the last coordinated sell-off. Weekly candles show momentum rolling over. Monthly structure is still intact, but barely calm. The question isn't whether this looks bad, it's whether the selling is technical noise or something being engineered on purpose. Look at the chart. Silver broke below the 50-day moving average, which acted as support for months, and RSI is deep into oversold territory, sitting around 28 on the daily. That's not normal volatility, that's a flush. The last time RSI dropped this low, silver consolidated for 2 weeks, then ripped 18% in under a month. But here's the difference. This time, it's happening while the dollar is weakening and treasury yields are rising. That's not a typical sell-off environment. It's a liquidity event disguised as a dip. Support is now at $31.50. If that breaks, the next floor is $29.80, which is where long-term buyers stepped in during the last major correction. Resistance sits at $33.20 and $34.50. Those are the levels that matter. If silver can reclaim $33.20 with volume, the dip was real. If it stalls there and rolls back under $32, you're watching distribution, not recovery. History shows that silver crashes hard and fast, but it doesn't stay down when the underlying drivers are still intact. In 2020, silver dropped 18% in 2 weeks, then doubled in 4 months. In 2016, it fell 12%, consolidated, and rallied 47% over the next year. In 2008, it collapsed 58%, then surged 440% over the following 3 years. The pattern is always the same: violent shakeout, tight range, explosive breakout. The question is whether this follows that script or whether something structural has changed that makes this different. The bull case is simple. If silver holds $31.50, the 50, and reclaims the 50-day moving average, this was a liquidity squeeze that clears weak hands and sets up the next leg higher. Targets would be $36, then $38 if momentum comes back in. The bear case is equally clear. If $31.50 fails and silver closes below $30 on a weekly basis, the trend shifts. That opens the door to $28 or lower, and it would take months to rebuild bullish structure. If you're buying this dip, don't chase it in one move. The smart play is a 3-entry plan. First entry at $31.80 if it holds above support. Second entry at $30.50 if it dips and shows a reversal candle. Third entry at $29.80 only if structure stays intact and volume confirms accumulation. If you're trading, your stop loss sits just under $29.50. If you're an investor, this is about positioning for what comes after the shake, not timing every tick. The difference between getting stopped out and catching the bottom is understanding that silver doesn't reward emotional decisions. This isn't a dip or a trap, it's both, depending on how you respond. The market is testing who understands the difference between price and value and who's reacting to headlines instead of structure. In the next 7 days, watch volume at support. Watch how silver behaves around $32 and watch whether the dollar continues weakening while silver stays heavy. If those 3 things don't align, something else is moving the price, and that's when you pay attention to what's not being said. The crash you're seeing isn't the story. The story is what happens when the dust settles and the players who shook you out start positioning for the move they already planned. Silver doesn't collapse this fast without reason, and it doesn't recover without confirmation. Right now, the chart is giving you both the warning and the opportunity. Which one you see depends entirely on whether you're watching price or watching structure. Silver didn't fall naturally. The velocity, the timing, the precision of this drop, it carries the signature of coordination, not capitulation. This isn't a market reacting to fundamentals. This is pressure applied from the top down. And the question isn't whether manipulation exists. The question is who benefits from keeping the price here. Silver has always been the most controlled asset in the commodity space. The futures market allows massive positions to be taken with minimal capital, creating synthetic supply that drowns out physical demand. Paper silver trades at volumes 50 times larger than actual metal changing hands. Price discovery happens in contracts, not in vaults. When enough short positions pile onto COMEX, the spot price follows regardless of what's happening in the physical market. This isn't theory, it's structure. 3 forces converged to create this collapse. The dollar surged as bond yields spiked, making commodities denominated in dollars less attractive on paper. A major hedge fund liquidation hit the market, unwinding, leveraged long positions across metals and energy simultaneously, and COMEX saw concentrated short attacks timed precisely when liquidity was thin. These weren't independent events. They compounded, and the effect was algorithmic selling that cascaded through stop-loss levels. Retail watched the price fall and assumed the trend had broken. It hadn't. It was engineered to look that way. Retail investors repeat the same mistakes every cycle. They panic sell at the bottom, convinced the asset is broken. They buy too early on the first bounce, mistaking a dead cat rally for a reversal. And they fail to distinguish between fake breakdowns, designed to shake out weak hands, and actual structural shifts in supply and demand. The difference is volume, positioning, and who's buying when the price is falling. Right now, physical demand is rising while paper price is dropping. That divergence doesn't last. The indicators are starting to align. Silver is oversold across multiple timeframes. RSI, stochastic, momentum, all signaling exhaustion. Volume spikes during the decline suggest capitulation, not distribution. And while the futures market shows continued short interest, physical dealers are reporting tightness. Premiums are rising, delivery delays are extending, the paper market is saying one thing, the physical market is saying another. That gap closes violently before entering. Confirmation matters more than conviction. Watch for a stabilization in volume, sustained buying that doesn't collapse on the next dip. Look for short covering on COMEX, visible in the commitment of traders report. Monitor the dollar. If it rolls over, commodities will catch a bid. Check whether miners are holding support levels. They lead silver, not the other way around. And finally, watch sovereign and institutional accumulation patterns. When the smart money starts positioning, it doesn't announce itself. It shows up in flow data, custody transfers, and quiet accumulation during periods of maximum pessimism. This isn't about predicting exact bottoms or calling reversals. With certainty, it's about recognizing when structural conditions favor asymmetric positioning. When paper mechanisms lose their grip on physical reality, repricing happens fast. When short interest reaches extremes and physical tightness builds beneath the surface, the spring compresses. And when retail has been shaken out completely, that's when institutional players step in. Not with headlines, but with scale. The current setup mirrors historical patterns where suppression created opportunity. Every major silver rally in the past 2 decades was preceded by a coordinated takedown that looked like the end of the trend. Each time, the narrative was that silver was finished. Each time, the physical market told a different story. The difference between those who capitalized and those who didn't wasn't luck. It was the ability to separate engineered panic from actual deterioration. This crash may be the biggest wealth transfer moment of 2026, not because silver will moon tomorrow, but because structural imbalances don't resolve peacefully. Suppression creates tension. Tension creates snapbacks. And when paper markets lose credibility, physical assets reprice. The levels to watch are $28 as first resistance and $25 as the line that confirms continuation. If support holds here, accumulation isn't speculation. It's positioning for what comes next.